Good afternoon. Welcome to our webinar. And do you know what your company is really worth? We are recording the webinar this afternoon, but we're only recording the presenters. So your names won't be visible to anybody watching the video later, but we record the video so anybody who misses this session can watch it later on YouTube. What we're going to cover this afternoon is just a very short introduction to ourselves to explain why we have the experience to talk about company valuations. And then we're going to move on to cover valuation topics, including why evaluation is important, why evaluation is difficult, a bit about methodology, strategic premium, and towards the end, a very quick bit on how we can help. And we'll then take questions at the end. So please feel free to ask any questions during the webinar using the Q&A facility that's at the top or bottom of your screen, depending on how you're viewing this webinar. And we'll pick up the questions and answers at the end. So if I can start by just giving a brief introduction to ourselves. We're corporate finance advisors who work exclusively full-time in acting for clients who are buying and selling businesses. We've been going 20-odd years, 21 years, and have done well over 100 transactions during that period. And we act for many clients who are looking at exiting their business at the end of their working lives, either through a trade sale or through a management buyout. And we also act for acquirers and we act for management teams on management buyouts. We very strongly believe in giving early stage advice. So to embark a client on a transaction that is feasible, a transaction that can be delivered. So as one of the early stage tools we use for most clients at the start of a transaction or before they even commit to going through a transaction is providing a detailed valuation explaining how a purchaser will look at their business, how a purchaser would value their business, giving our comments on the different elements of the business and on the valuation, and producing a report setting out our opinion and the importance of the valuation, and importantly giving all our comments and our workings and explaining why we've arrived at that figure. Our valuation reports are typically 20-odd pages long, and they carefully explain the valuation process, and we get under the skin of a client's business to give a valuation that, in our experience, where we then go on to act for those clients, is usually accurate within 10% either way. When I say either way, usually we're on the cautious side. So usually when we go through a sales process with proper marketing of the business, we're able to beat the valuation, but it's by 10%, 15% sometimes. So the valuations are accurate because of our experience in doing deals over the last 20 years. We know how purchasers look at businesses, and we know what is achievable. Greg later will talk about strategic premium, which is where you might get a slightly higher valuation. Greg will come on to talk about that in a few minutes' time. So evaluation is often a very good starting point for ensuring before a client decides to embark on a transaction that the valuation is what they need it to be, and they understand where the path is likely to lead in terms of valuation. We also do detailed exit option reviews where we go beyond the valuation. If it's a trade sale, we'll look at buyer activity in their sector. If it's a management buyout, we'll look at funders' appetite and set out what the deal structure would look like. And our main services are to provide lead deal advisory services. So once the early stage advice has been given and the client embarks on the transaction, it's helping them from start to finish through that transaction, which if it's a trade sale involves doing detailed research using powerful subscription databases to find potential purchasers worldwide. If it's an acquisition search, it's using similar tools to find acquisition targets that meet a client's criteria. If it needs fundraising, which it would do nearly always if it's a management buyout or a corporate acquisition, we will help with the fundraising process and introduce it to funders who we know ought to have an appetite. And very much it's giving advice throughout the whole process, trying to spot areas that will cause issues and deal with them early on, negotiating the deals and project managing through to completion. There's 3 photos there. We're all on the webinar today. We'll all join the question session at the end, question and answer session at the end. We see our strengths as being, this is what we do full time. We've worked together as a team for more than 10 years. We enjoy doing what we're doing. We've just had an incredibly busy year in 2021 with more deal activity than we've seen for some time. And the signs are that 2022 is going to be even busier. And that's partly being driven by, I think people have been through COVID and thought about what they want and whether it's a good time to retire, hand over responsibility. And it's partly been driven by the expectation that capital gains tax rates may go up significantly in the near future. So that's a bit about who we are and what we do. There's some deals on that sheet, some photos of deals on the sheet. The same thumbnail photos appear on our website and are clickable. So if any of those stand out and you want to know a bit more about those deals, go to our Strategic Corporate Finance website, go to the recent deals section and click on the photo and it'll tell you about each one of those deals. But you can see we act in the SME sector. So most of those businesses are turnover between £2 million and 15, 20 million pounds, with a few higher. But most of the clients we act for will have a turnover of 2, 3, 4, 5, 6, 7 million pounds. So very much in the SME sector across most industry segments. So I'm going to hand over to Greg now, who's going to take us through the valuation, talking about valuation. Then I'll come back on at the end to talk about how we can help, and we'll answer your questions at the end. So please do use the Q&A facility at the top and bottom of your screen to ask your questions, and we'll pick up on those right at the end of the webinar. We have allowed time for those questions, so we won't go over the 1 hour we said we would do. This content will take about 40 minutes in total, leaving plenty of time for questions. So please feel free to ask questions if you wish to. Thanks, Greg.
Thanks very much for that introduction, Andrew. Afternoon, everybody. So to start off with, I'm just going to talk about why valuation is important. And for most business owners and all of our clients, or most of our clients, it's their most valuable asset. It's probably central to their pension planning. And therefore, it's really important to have a clear idea about what the value of that asset is, and also understand what factors would lead to an increase in that valuation, and what factors might be detracting from its valuation. And those sorts of things will help enable better strategic decision making. Probably a better way of explaining why valuation is important is to think about some of the situations where business owners can get into difficulty if they don't have a clear understanding about their business's value. And probably the most sort of common example we come across is where business owners place their company on the market looking for a buyer, and we might come across this situation where we're acting for an acquisitive client looking to make an acquisition, and the business owners might have unrealistic expectations about what their business is worth, and find out that offers received for their company don't match up with their expectations, and the process has been a waste of time and money. So having a clear understanding of what a realistic valuation is really important in that sort of situation. In a similar vein, having excessive price expectations might be a problem if unsolicited offers are received for a business, and business owners don't properly sort of engage with potential buyers in those situations. And also looking at the other side of the coin, if business owners are looking to incentivize their key staff with share options and grants share options, again, having unrealistic valuations might create difficulty in setting up these schemes properly. And this is especially difficult with smaller businesses where it's unclear exactly what the valuation of the business might be in a few years' time. And so we've seen instances in the past where an EMI scheme has been set up, and maybe it's been completely ineffective if there's a certain price hurdle that needs to be reached before the share options can be exercised, and if that valuation isn't achieved, then it can actually sort of disincentivize management if their share options don't have the value that they thought they would have. And another sort of key situation that we've come across a few times is where you've got several shareholders in a business, and maybe the older shareholders are bought out, or minority shareholders are bought out a few years in advance of the other shareholders. And if that initial transaction to buy out minority shareholders is at too high a value, then that can seriously sort of erode the value for the other shareholders. So I think it's especially important to have a professional valuation undertaken if you are considering buying out minority shareholders. I can just move the slide forward. No, it's not working. So moving on to why valuations are difficult. The first reason is that there's a lack of information out there for business owners to rely on when it comes to working out what the valuation of their business is. For most private businesses where transactions do occur, it's rare that the deal value is disclosed, and where it is disclosed, it's difficult then to work to find out what the underlying level of profitability is for that business. So even if you do find out that a business similar to yours is sold for a certain value, you never really know, what the multiple is that's been used to work out that valuation. So there's a sort of an information vacuum, which is sort of difficult to get around, and that means that it's important to sort of take advice from professionals operating in the deal making market who have worked on similar deals and can use that experience to value businesses. Another reason why business valuations can be difficult is that it does require a certain amount of detailed knowledge about a business to properly weigh up its value, and the value is largely driven by the growth potential of the business and also the risks that are inherent in the business that might cause the performance to decline in the future. So because you need that sort of level of knowledge about the business, it's difficult to rely on rough calculations based on sort of basic data. So you might come across websites that can provide a quick and simple valuation based on turnover or profit and what industry a particular company is, but that's really sort of too superficial and doesn't take into account the individual factors that affect a valuation for a specific company. And there's an awful lot of judgment needed. So once you've got that sort of knowledge of how businesses are valued, you understand the business properly, you'll find that there's many different sort of factors that go into a valuation, and all of those need to be weighed up and assessed and weighted accordingly to try and come up with a sensible valuation. So there's a lot of judgment. There's exceptions to everything. So there's a few sort of rules and mechanisms that we follow when valuing businesses, which I'll talk through over the next few slides. But there's always exceptions to everything, and everyone's got a slightly different way of arriving at valuations. So there is a significant amount of subjectivity and judgment that goes into valuations. So because of the reasons I've just outlined, be very careful about relying on basic valuations or free valuations. If somebody is offering free valuations, then just think about whether they're likely to be biased in some way. So it might be that if a company is looking to win sale mandate work to take a business to market, then maybe that sort of incentive there for them to inflate a valuation and persuade business owners to place their business on the market. So moving on to how we actually go about valuing businesses. In almost all cases that we come across, we tend to value businesses on a multiple of profits, and I'll talk more about that methodology in a moment. There are some other methods that you can use to value businesses, and whether these are appropriate or not depends on the circumstances. But I've outlined 3 other alternatives here. You've got a multiple of recurring revenues, and this might be seen in certain kinds of businesses, maybe software businesses or professional services. This is a more sort of a simplified way of working out a business's value rather than looking at profits. You've also got net asset value. So this might be appropriate where you've got a modestly profitable business or a business that's breaking even or has a very high balance sheet value compared to its profits. But just a word of warning there. Sometimes it is tempting to think that your balance sheet value or net asset value is the minimum sort of value that's your business might be worth. That isn't always the case. If it's a loss-making business, then it might be appropriate to factor in sort of shutdown costs or other discounts against that valuation. Yeah, just be careful about treating net asset value as an absolute minimum. And finally, the other sort of alternative valuation method is discounted cash flow, where this is based on a projection of future profits and cash flows over a number of years that are then discounted to present value. And you might find this method is appropriate for early stage businesses where there isn't that sort of track record of profitability that can be used to work out a valuation. And it might also be seen when it comes to working out share valuations to agree with HMRC for share options in some cases. But I'll talk more about the multiple of profits method, which is the method that we use most often. So this is applicable for most mature and profitable businesses, which tend to be the companies that we advise in our day-to-day work. And it's a very simple basic formula. So this is you'll work out the underlying profits of a business and then multiply it by a number which we call the earnings multiple. And then that will give a debt and cash free value or enterprise value, which is the valuation of the business, assuming that it has no surplus cash, no debt on the balance sheet. So that's a hypothetical valuation and needs further adjustments to work out what the value is on a particular date, taking into account whatever surplus assets or debts there are on the balance sheet at that date. Which I'll talk more about later on. So it's like I say, quite a simple valuation, which is a bit misleading because there's a lot of sort of professional judgment needed to work out exactly what the underlying profit is and also what the earnings multiple is. And I'll talk more about those over the next couple of slides. So the first part of the equation is underlying profits, and how do we work out what that profit figure should be? Usually it's the operating profits disclosed in the company accounts or earnings before interest and tax, or it could be EBITDA, which excludes the impacts of depreciation and amortization charges, and that's EBITDA can be used if it's a service business where there's not a significant amount of capital expenditure needed in the business. If it's a capital intensive business where a large proportion of profits need to be reinvested into fixed assets on an annual basis, then it is really important to use EBIT as the basis of valuation, because then it's taking into account the ongoing need to invest in fixed assets. So that's an important point to sort of to consider. Sometimes you might see valuations of capital intensive businesses based on EBITDA, but that sort of fails to take into account the ongoing investment that's needed in fixed assets. The EBIT or operating profit figure noted in your accounts might include exceptional income or exceptional costs that need to be adjusted for when working out the underlying profit figure. So if there was a one-off contract that sort of made the profit in a particular year much higher than previous years, then it might be appropriate to take that out and just sort of take an average of or take an average over a number of years. In most small businesses and medium-sized businesses, you tend to find that the business owners are involved in director roles and may not pay themselves on an arm's length basis, preferring to pay themselves by dividends for tax reasons. And therefore it's important to adjust the profit figure to allow for a market rate cost of management rather than the actual cost that's going through the P&L. As I mentioned, it might be appropriate to take an average over a number of years if the profitability ebbs and flows each year. Or alternatively, it might be appropriate just to take an operating profit figure based on the last quarter's results or the last 12 months results. If the business is growing at the current run rate, might be more important and more applicable than an average over a number of years. So there's a bit of sort of subjectivity there and judgment needed to work out what the underlying profit should be to use as the basis of the valuation. And then the second part of the equation is the multiple. This is even sort of more difficult to work out and requires more judgment. As I've mentioned, it is basically linked to the quality of the earnings, which is how likely they are to grow in the future versus risk factors that might lead the profits to decline. So breaking that down into different things, you look at the recurring revenues of a business. If it's a business that enjoys a high proportion of recurring revenues, then that would lead you to use a higher multiple, reflecting that you've got greater certainty that the earnings are going to continue into the future. A business with good or high barriers to entry, again, would lead to a higher multiple in that the business has a better market position and is more protected from new entrants to its market. Market position is really important. If it's a business with a leading market position that has a position of dominance, then again, that's going to lead to a higher multiple. The spread of customers, and this is often an issue with clients we work with, is fairly common that for smaller and medium-sized businesses, there may be a significant amount of concentration with a handful of customers. That will be seen as or is often seen as a risk by potential buyers, and they'll look to discount the valuation to reflect the risk that one or two customers might leave, and that would have a significant sort of, impact on the profits of the business going forward. The growth potential, so all businesses will have growth potential. It's just how tangible that is, whether there's a business that's sort of invested in made investments to enable future growth, and those are more tangible, are likely to have a higher multiple compared to businesses where there's more sort of intangible growth potential that might just be linked to increased sales and marketing, say. And another key sort of thing that comes up again and again with small and medium-sized businesses is the strength of the management team. So, as I mentioned, for many smaller businesses, the owners of the business might be hands-on, involved in the day-to-day management of the company. That's is likely to be seen as a risk factor in the eyes of potential buyers, because if the owner of the business is also the key manager and then they retire from the business either at completion of a deal or shortly after, then that could lead to a decline in the performance of the business going forward. So the stronger the management team, the more people they are involved in running the business, the less reliance there is on one or two key people. The higher the quality of the earnings and the multiple is likely to be. So there's lots of reasons there, lots of factors that will have an impact on what the multiple will be. It is a subjective sort of process to work out what the appropriate multiple will be. That said, in most cases, the multiple will be within a certain sort of range for SME businesses. So most, if you're looking for funding and talking to banks or private equity investors, they'll have a sort of an assumption that most SME businesses they see, the multiple is unlikely to be more than sort of say 5. There's exceptions to everything, and obviously there'll be many businesses where the multiple should be more than 5. As I mentioned before, there's a lack of information out there concerning valuations, and there's no reliable sort of published lookup tables that exist that you can sort of refer to look at what the multiple should be for a particular company in a particular sector. I think that they are published data is out there, but I'm yet to find one that's personally I find reliable and I would use when it comes to valuing businesses. And where I have seen sort of published multiples before for companies, they tend to break it down into multiples applicable for companies in different industries and different sectors. The industry or the sector that a company is in is relevant to an extent when it comes to deciding what the earnings multiple should be for a business, but I find that it's the individual factors affecting the company itself which are more important rather than the sector that the business is in. So once you've kind of gone through the process of working out the underlying profits, deciding what the multiple should be, you'll be able to work out what the cash and debt-free value of a business is. And then the second step of the valuation is working out what the value of the shares is, taking into account what the balance sheet looks like, and in particular, any surplus assets that are on the balance sheet. So there might be freehold property on the balance sheets, which would add to the valuation. What we do when working out the cash and debt-free value is to assume that the business is renting its premises, so allowing for a notional rent cost, and then that means that we can add on the value of the property if that's on the balance sheets, and make sure that that's taken into account when working out the equity value. Most of our clients will be sort of mature, profitable businesses, and will have a cash reserves on the balance sheet over and above what's needed for the day-to-day operations of the business, and that surplus cash would be calculated and added on to the value of the equity shares, along with other surplus assets like property. If there's any debt on the balance sheet, that would be taken off when working out the value of the equity shares. And corporation tax, in the context of working out valuations, is treated as a debt item. So there will always be, even if it's a profitable business that doesn't have any debt, they'll have a corporation tax liability, and that will be treated as a debt item and be deducted from the equity valuation. So is it one sort of further point to make here is that the debt and cash free valuation and the equity valuation, they include the key assets on the balance sheets that are needed in order to generate the profits upon which the valuation is based. So whilst we'll add on to the equity value the value of surplus assets such as freehold property, the value of assets actually used in the business, such as its working capital, its stock, debtors, etc. Those are included in the valuation already, and therefore it's not appropriate to add on those assets on top. One sort of there's exceptions to everything when it comes to talking about valuations, and this is an example of another exception. There might be some instances where it's sort of industry accepted practice to add on the amount of net assets to an earnings based valuation, and I have come across that situation fairly recently. In that particular case, the net assets of the business and net assets of businesses in that particular sector weren't that significant in the context of the valuation. But it's interesting to important to understand that there are exceptions to everything, but I'm just talking about general rules. Andrew mentioned at the top that there's what's often referred to as the strategic premium, which is where a strategic buyer will pay over and above what a business is worth on a standalone basis, based on its existing profits and balance sheets. If it can benefit from certain synergies and drive additional value from an acquisition. So this situation might come about if you're selling to a corporate purchaser that is undergoing a buy and build strategy. So it might be buying up lots of businesses to combine into a larger business, make cost savings, and look to cross-sell services and products between different businesses in their group. So in that sort of situation, they may be willing, because it's a key part of their strategy to grow by acquisition, they may be willing to pay over and above what a business would ordinarily be worth. Or you might find this sort of situation where there's a high quality business that is being sold, and there are a number of competing bidders, again willing to pay over and above what a business might be worth ordinarily, because it is sort of a business in limited supply, and there's simply people willing to pay more. But it's risky to assume that this sort of premium can always be attained when it comes to selling your business, and that's because most buyers, they operate on a rational basis, and they will want to buy a business for as cheaply as they can, and if they can do that without paying a premium, then they will do. And also most trade buyers are quite risk averse, and as well as factoring in the potential growth that they can achieve from a business, they'll also be thinking very consciously about what could go wrong, whether they might lose clients from taking over a business. And that will also factor into their valuation. So you should never sort of assume that this sort of premium can be achieved, and more, it's better to think of it as a bonus if we can get that. Is there a tendency for owners of small and medium-sized businesses to sort of overvalue their business? We find that sometimes business owners do have a higher sort of place a higher valuation on their business than buyers would, and that's for a number of reasons. Probably, one of the key ones is that for business owners, it's more than just a revenue stream. It's more than some underlying profit multiplied by a number. It's also their livelihood, and as well as the profits of the business, it will provide their employment, and they'll receive a salary from the business. It's quite often it'll provide a living and a salary for their family members as well. So it's more than just a profit stream, which is what we're looking at when we're valuing businesses. There's also the potential to maximize their value by delaying a sale until further into the future. And for that reason, we find that most transactions take place when owners are genuinely looking to retire, and therefore the reason for the deal is not a purely financial reason, looking to maximize the value of their shares. It's been driven by a need to step away from the business and retire. There's also the inherent optimism of entrepreneurs. They set up and run businesses in the expectation that they're going to do better in the future than they are at the moment, and therefore there's sometimes an expectation that buyers will only see the benefits in owning their business, and therefore will pay a fuller price. Contrast that with the view of most buyers. They're going to look at a business more objectively compared to the owners. They'll be looking more closely at the risks that exist and what could go wrong if they buy a business. Whereas the owners of the business, they will know in every aspect of their business, understand the risks very clearly, and have a different view on those compared to potential buyers. So just to wrap up on what I've talked about, we would strongly recommend that if you're unsure about the value of your business, to take advice, talk to us, and get a professional valuation undertaken, which will set out in detail how your business should be valued, and the kind of factors that go into the valuation. Beware of free valuations. They could be biased, or they could just be very simplistic and be unable to be relied upon. Valuations normally are derived from the underlying profitability of the business. Even when a valuation is based on recurring revenues or balance sheet value, it's important to look at the profitability as well as a sense check as part of working out a valuation on another method. Don't always assume that buyers will pay a strategic premium for a business. And finally, valuation is only part of the picture. So quite often, when we're talking to business owners, there will be sort of there's a sort of preoccupation on the sort of headline valuation and what the multiple is for a transaction, but other factors are just as important, such as how saleable a business actually is. So it could be that a business has a high valuation, but it's just a very difficult one to sell for different reasons. Alternatively, if you're looking at buying a business, then the valuation isn't be all and end all. How you actually go about funding a deal is probably more important. So sometimes it's more, it can be worth paying a higher valuation, provided that a deal is structured in a certain way that allows funding to be obtained. So valuation is one of a number of things to look at. And I'll hand over to Andrew at this point to talk about how we can help.
The slides seem to have got a life of their own today.
They
Thanks,
have.
Greg. Yeah, I think we've, just before I do talk about how we can help, just to encourage questions and answers. If you want a question or answer to be asked, please use the Q&A facility. We have had a number of questions asked so far that we'll pick up on in a minute, but there is time to answer further questions. So if you've got a question, please use the next couple of minutes to ask that question, and we'll answer it in a few minutes' time. I think we've covered most of how we can help on the valuation report with the introduction and what Greg has just said. But just really to sum up and say, our valuation reports, they're fairly comprehensive documents. We don't just present them, we sit down and take you through them. And they will give you a great insight into how a purchaser would look at your business, what they would see as driving the value, maybe some items draining the value. And ideally, if you did the valuation 2 or 3 years before you're thinking of exiting, it gives you time to take key decisions that may well impact on the valuation. And sometimes you can take decisions that have a double impact by the same decision can improve the profitability and also improve the multiple. So we've seen many clients in the 2 or 3 years before selling, they've suddenly become focused on the exit. They've got an understanding on how the exit value will be driven, how it will be calculated, and they've made changes to their business that has increased the value of their business 2 or 3-fold in the last few years, just before they exit. So the earlier you get to valuation, the better. If you're about to do an exit and you're ready to start the process, evaluation should confirm whether now is the right time or whether there's work to be done first. Most of our valuation work comes through accountancy practices, and often we have to do it because we do deals day after day. We're working full time in the corporate finance world, and therefore understand how purchasers in different sectors will value different clients. Accountants often ask us to do valuations because they feel they've got a conflict of interest, particularly if one director is buying out another director and the accountant has acted for both for many years. So evaluation report as a starting point is usually a very useful exercise. So as I say, we're going to move on to questions, and Catherine is going to join us now to host the questions. It's not too late. If you want to ask a question, please do, but we'll start with the questions that we've got so far, Catherine.
Hi there. Right, the first question is, what's been the impact of COVID on valuations?
Shall I kick off on that, Greg?
Yep.
It almost feels like, I know COVID isn't behind us day to day in terms of infection risk, etc. But in terms of the corporate finance world and the deals we're doing, it feels very much behind us as an issue that happened in March, April, May 2020. But that obviously depends on the sector your business operates in. If you operate in the hospitality sector, clearly you've had a dreadful time of it. For many businesses, we find it's behind them, and we're as busy as ever. So I think the answer to that is it depends. It depends on how COVID has impacted on your business. We've seen many businesses have actually benefited from COVID because of what they do or because of their income being contractual, yet they laid off staff and claimed furlough. What we're interested in evaluation is what the profitability is likely to be going forward, rather than any hiccups and windfall surpluses over the last 18 months or so. So it depends is the answer, but for most businesses, it's not having a big impact on deal activity or valuations anymore.
Okay, thanks, Andrew. Next question is, do we ever see multiples in SME company sales exceeding 5?
Greg, do you want to take that one?
Yeah. Yeah, I mean, the answer is we do. Quite often we see that in, say the software sector, where you do sort of have quite high multiples compared to most of the sectors, and that's comes down to the kind of factors that I've talked about, such as the growth potential and the kind of barriers to entry that exist in terms of the sort of intellectual property in those businesses. So software, you might find higher multiples. Also, for instance, care homes and during my sort of presentation, I talked about freehold property being removed from the valuation and treated separately for most businesses. There's an exception for sort of residential care businesses where the care home is treated as a sort of a key asset of the business and would be included in the sort of the cash and debt-free value and enterprise value. So for care homes, for instance, you would expect a multiple of more than 5, partly because it would include the freehold property that's used in the business. So it does depend on the business and the sector, but yes, for certain businesses, we do see multiples in excess of 5.
Okay, thanks, Greg. Next question: what's the typical time frame for evaluation from appointment? So from when we've been asked to do one.
The typical time for it depends how fast the information comes across to us. Once we've had all the information, we start by being appointed, we send an engagement letter, we send an information request showing the information we need to do the valuation. And we always say to clients, if some of that information is difficult to obtain or time consuming to obtain, please talk to us before putting in many, many hours. But what we're asking, we don't expect to be difficult to obtain for most businesses. Once we've received that information, it typically takes 2 to 3 to 4 weeks at most to turn it around. And it can be quicker if we ask clients to send the information through piecemeal as it becomes available. So usually we get the annual accounts first, which allows us to kick off and start the valuation. So when the other information comes through, we can sometimes turn it around very quickly. So it depends, it can be very quick. But the main factor is how long does it take to get the information we're asking for is what tends to cause the most delay.
Thanks. And a follow-up question to that one: what's the cost of evaluation? Is it fixed or does it vary depending on the company size or complexity?
If it is a single trading business, we typically charge £3,750. If it is multiple businesses and we've got consolidated accounts, we'll usually charge just slightly more, £4,250. If it's got, we'll always look at it, and for smaller businesses where there's less work, we may quote a lower fee. If it's really complicated, we may charge a higher fee. But mostly it's £3,750. Occasionally £3,250 or £2,750 if it's simpler. Sometimes £4,250, around that sort of ballpark. So it is variable to an extent, and it certainly does. It depends on the complexity more than the business size, really.
Okay, thanks, Andrew. That's all the questions for now.
Brilliant. Well, thank you very much. We're going to put this on YouTube, so if you've missed part of it, it'll get loaded up to YouTube tomorrow. You can watch it, or if you've got colleagues who would like to watch it, it'll be on YouTube tomorrow. Catherine will send out the link. Thank you for listening. And if Catherine will be in touch, she'll send you the slides. And if we can help and have a chat to you via Zoom or Teams or in person, just to see how we can help you, would like to do so. So thanks for listening, and I'll bring the webinar to an end now. Thank you.